Well, what a wild earnings call once again for Tesla. I mean, seriously, if you look into the numbers, there are some amazing things going on underneath the surface, and it's simply amazing. But you guys know that I'm not a pumper, so I have to be honest. There were a lot of not so great things either, and I really think Wall Street is setting up to screw Tesla shareholders. So I'll give you the reasons why they may try and what it all means. And we have a special guest analyst on that's coming on at the end that's going to give his take as well on this earnings call, so you don't want to miss out. Let's just say he's really bullish. So let's dive into all of it right after you gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. So Tesla honestly had an okay earnings call. I mean, there was some good, there was some bad, some good long-term signs, and some not so good short-term things that we cannot ignore. But I cannot wait for our main man, Gordon Johnson, to come on and talk about Tesla's demand problem or their inability to turn a profit, despite the fact they're turning a profit, or about how legacy auto is just eating Tesla's lunch, despite, well, honestly, everything saying the exact opposite. It doesn't matter if other automakers actually compete in terms of having some vehicles to buy. Tesla has a margin that none of them can touch, and oh, by the way, I'm sure Gordon Johnson will conveniently forget to show how the other automakers reported as well, in comparison to Tesla in terms of growth or profitability or margin or anything else that's awesome out there. But the big surprise to the good side was the free cash flow coming in so nicely and starting to trend back up despite the price cuts, and of course revenue coming in so strongly despite those exact same price cuts that happened with Tesla vehicles. So Tesla is becoming more efficient even if the margins did move a bit lower, and the free cash flow number just basically proves that they are being more efficient despite the fact those margins coming down. But I cannot say those numbers are all great either. There's a lot of big price target projections that are based on massive margins, which they honestly can get to at some point in time. But a lot of those models show it basically every year for the next 5 years, and we're already going to be severely behind the 8 ball this year at a minimum. So a lot of those price targets are honestly kind of busted to begin with in regards to getting there over the course of the next few years. But their margins aren't what concern me at all. They are well within what they need to be and still allow Tesla to just basically print money, unlike every other automaker out there. And quite honestly, they came in better than expected, both for myself and from Wall Street, if I could talk, and from Wall Street's expectations, so that is good news there. But what does concern me was the lack of performance on solar, and I have been saying it for several years now that I just don't like the solar product at all. I think they should get out of that business altogether, as I have tried to put Tesla Solar on some rentals that I've had, and when you needed new roofs on those rentals, it would take like 25 years for that actually, the cost and everything else involved to actually make sense versus just buying a lifetime regular roof and moving on with life. So it basically only makes sense in a very select areas, like California and other areas like that where the cost of, your energy bill is really, really high. And the incentives that you get for solar are actually a lot relative to everywhere else. So for me, it's something I haven't liked for years. And these numbers then this performance in solar kind of prove it out even further this quarter. I also did not like the adjusted guidance down in regards to Q3, and then the lack of answering of questions and clarity around all that. And of course, Cybertruck not being quite ready to contribute substantially to the bottom line this year is something else that I just quite honestly didn't like. And all of this lays the foundation for Wall Street to try and keep Tesla down and completely screw with us as investors. And there are 3 main reasons for that, and the last one could just be devastating for Tesla stock. But don't worry guys, I have a solution for that too if that indeed does happen. So reason number 1 is Wall Street is still not sold on Tesla itself or Elon, or both really if we're being honest. Like it or not everyone is sold on where Tesla is going, what they are trying to accomplish, and what it will do for the share price ultimately. You also have many large investors that do not like Elon and his antics and would prefer a much more, buttoned up suit and tie kind of approach to running a company. And just look at all the Twitter drama to see an example of what institutional investors absolutely hate. Now, I'm not going to rehash all that again here, but I had to mention it because it's true whether we like it or not, as he continues to make wave with everything going on with Twitter. We all know that Tesla would not be where it is if Elon was not out there being Elon in the first place, but this will continue to be a sore point and a sore spot now for a lot of large investors. The second reason is because a recession or a slowdown is still on the table this year, or basically is honestly already here, and that usually hits the auto industry very, very, very hard. But don't yell at me. But for now, many view Tesla as a car company, And we cannot just dismiss that position altogether when the cars make up the vast majority of Tesla's revenue. Now, clearly they are better than everyone else and next level on all kinds of things, but when dealing with Wall Street, they look kind of very macro at times at things like this. And if the prevailing wisdom is car manufacturers get crushed during a recession or a slowdown, you bet your bottom dollar they will look to try and punish Tesla, at least in the short term. And finally, we have the earnings call itself and the numbers. Here's the problem with these earnings, which were not great, but they weren't terrible either by any stretch of the imagination. They were just kind of good. There has been doom and gloom about the earnings recession or earnings crash, which just hasn't happened once again so far. We heard it was coming the last quarter until it didn't, and same for the quarter before, and the quarter before, and the quarter before. Now, to be clear, earnings have not been just perfect either, the best ever or anything like that, but we were absolutely not a disaster or an apocalypse as described by almost everyone leading into the last quarter for the stock market, and a lot of people were still parroting that narrative into this quarter for the stock market. Which, of course, in true YouTube or media fashion, you just say something like, well, it didn't happen this quarter, but wait until next quarter. Well, it's next quarter, and earnings have not been too bad so far, and obviously, despite a lot of headwinds we are seeing, there have been lots of top and bottom line beats, strong guidance, and maintaining of guidance, and the banks were all across the board saying that consumers and businesses are still strong and well positioned for anything that may come. But that right there is where the problem lies for Tesla. Unlike previous quarters where Tesla did a great job and crushed the numbers, this was the second quarter in a row where the numbers were good, but not great. And it's proving Wall Street's point that Tesla is getting hard just like the rest of the automakers, even if the reasons why are completely different for Tesla versus those other automakers. The reason why they're getting hit is completely different, but they're not going to look into that far, and they're not going to do that. That is a setup where Wall Street just loves to pummel a stock and send a stock down, just as people are starting to feel comfortable once again with Tesla and kind of see it go on a nice run and kind of hit that nice solid ground. And if you weren't buying in the 100s and instead bought the rally up to almost 300, that can be a very unnerving position to be in. So what the heck happens then? Well, the truth is, this should excite you as a long-term investor. Basically, Tesla is executing incredibly, and you can still buy shares at these prices and potentially lower if Wall Street gets really, really stupid again. And this is the exact scenario every long-term investor wants with every stock they want to own long-term. And that would be an extended time of incredible performance by a company, but the stock price stays flat or actually goes down. Then you have even more time to add more shares at cheaper prices. This happens all the time, and the longer it goes, the bigger the slingshot is when it finally runs. And it will eventually run, guys. And then you will actually have more shares than you would if it had just run up a lot earlier. And then, of course, people are going to FOMO into the stock just like they did because, it came out of nowhere, just like Tesla did in 2020. The reality is, Tesla didn't come out of nowhere, and those that bought in 2016, 2017, 2018, or even earlier saw signs all over the place that it was going to be a beast at some point in time. And they absolutely got the benefit of that rubber band being pulled kind of so tight that not only did Tesla run, but it ran up big, and if you were adding that whole time, they also had far more shares than they normally would have allowed them to buy and able to actually build a lot more wealth long term than if the stock had not traded flat for 6 years. That's also the reason why I don't trade. I just buy and hold and take advantage every time Wall Street gets stupid and sends Tesla back down to my price target. That is how real long-term wealth is built. But to get another perspective on these earnings, I'll turn it over to the Tesla bull.
Do you see this? These are Tesla power gloves because even the Tesla ball couldn't handle the power of Tesla's earnings. Let me help you understand these earnings because Luke's a complete idiot and couldn't get a date no even if he had $1,000 in his pocket. So let me break this down for you guys visually. This is Tesla right here. This is what Legacy Auto looks like. And then this is what that complete idiot Luke looks like. Who do you want to look like? This guy, or Tesla? Let me help you out if you don't know the answer. This is what $1 trillion per share looks like because I'm a Tesla bull.